Debt. It has built civilizations. It has toppled empires. It has fueled innovation. It has triggered collapses. From the earliest records of Mesopotamian loans to the modern derivatives markets, debt has been the invisible engine of history. The promise of borrowed resources has always held the allure of growth, power, and influence. But like all engines, it can overheat, break, and spread destruction if mismanaged. The story of the debt supercycle begins long before modern finance. In ancient civilizations, rulers borrowed to fund wars, infrastructure, and luxuries beyond their immediate capacity. Temples, aqueducts, and city walls were built not with existing resources, but with promises to pay. Merchants, kings, and priests all participated in a web of obligations, some formal, some implicit, that could ripple for generations. Debt is deceptively simple. You borrow today, promise to repay tomorrow. But in practice, it is far more complex. Debt carries incentives, constraints, and consequences that extend beyond any single borrower. For empires, the ability to mobilize debt often determined longevity. Rome's expansion relied on war loans and tribute-backed financing. The empire's collapse was accelerated when the chain of obligations became too heavy to bear. Fast forward to the modern era. The Industrial Revolution transformed debt from a tool of survival into a tool of growth. Companies borrowed to invest in factories, railways, and machinery. Governments borrowed to fund public works, education, and militaries. Central banks emerged to manage liquidity and stabilize markets. Credit became abundant. The promise of future productivity justified borrowing at scale. But as debt accumulates over decades, patterns emerge. Economists now call it a supercycle, a multi-decade rhythm in which debt levels rise, interest payments escalate, growth slows, and eventually, a crisis triggers partial deleveraging, only for the cycle to begin again. What makes the debt supercycle different from normal cycles? Ordinary recessions are short-term corrections. They rebalance markets, clear inefficiencies, and allow for new growth. A supercycle is structural. It affects multiple economies simultaneously. Debt becomes so large that paying it off is hardly possible without restructuring. In the 20th century, supercycles manifested several times. After World War I, nations faced unprecedented sovereign debt. The 1920s saw rapid credit expansion in the US. This culminated in the 1929 stock market crash. Governments tried to stabilize with new borrowing. However, the debt burden often exceeded productive capacity. The result was deflation, unemployment, and economic hardship. Debt and leverage are not inherently bad. In fact, they're essential for growth. Businesses use debt to scale. Individuals invest in education or property with debt. Nations borrow to finance infrastructure and social programs. Debt amplifies productivity until it amplifies fragility instead. By the 1970s and 1980s, advanced economies entered a period of high inflation. Rising interest rates and mounting private and public debt emerged. Oil shocks, fiscal deficits, and global competition tested the limits of borrowing. Governments turned to monetary policy and financial innovation. New instruments like derivatives, helped manage risk and sustain growth. Modern debt is no longer local, it is global now. Banks lend across borders, and pension funds hold sovereign bonds. Multinational corporations issue debt in multiple currencies. Credit default swaps allow investors to hedge against defaults. Exposure multiplies, and systemic risk becomes opaque. Here lies the paradox of the supercycle. The very instruments designed to manage risk allow debt to accumulate faster. Securitization, derivatives, currency swaps magnify leverage. Interconnection is amplified, and liquidity appears abundant until it vanishes. 2008 was a warning. The global financial crisis revealed the fragility of an over-leveraged system. Mortgages were packaged, sliced, and sold. Insurance instruments multiplied exposure beyond comprehension. Banks assumed that diversification would spread risk, but in reality, it concentrated systemic vulnerability. When housing prices fell and defaults surged, the entire structure nearly collapsed. Governments intervened. Trillions were injected into banks. Interest rates were slashed. New regulations were implemented. And yet, the supercycle continued. Debt levels today exceed pre-2008 peaks. Governments, corporations, and households remain highly leveraged. Central banks now hold unprecedented influence over global financial stability. The danger of a debt supercycle lies in its momentum. Debt is self-reinforcing. Borrowing stimulates growth, which enables more borrowing. Low interest rates reduce the cost of debt, incentivizing further leverage. Asset prices rise, creating a wealth effect that encourages more borrowing, and the system becomes dependent on continual expansion. A fragile equilibrium where growth must persist or collapse follows. But history shows that no supercycle lasts forever. At some point, the cost of servicing debt exceeds the capacity to repay. Investors demand higher yields. Credit tightens. Asset prices falter. Defaults cascade. And central authorities scramble to maintain stability. In today's world, the supercycle is complicated by technology, globalization, and monetary innovation. Digital currencies, high-frequency trading, shadow banking, and global supply chains create a web of interdependence far more intricate than anything previous generations faced. A default in one corner of the system can ripple instantly across the globe. Liquidity is fast, but so is contagion. This makes understanding the debt supercycle critical, not only for economists or investors, but for anyone who participates in the financial system. It shapes job markets, inflation, housing affordability, and wealth distribution. It influences geopolitical power and even social stability. So what can break the supercycle? Historically, there are three primary mechanisms. Default, when debtors cannot repay, obligations are renegotiated or forgiven. Sovereign defaults have redrawn maps and toppled governments. Corporate defaults have destroyed fortunes and reshaped industries. Governments and central banks can erode debt in real terms by increasing prices. High inflation reduces the burden of nominal debt, but at a societal cost. Savings are destroyed, purchasing power diminishes, and inequality rises. Coordinated interventions, bailouts, and regulatory changes can temporarily stabilize the system, but often they just defer the problem. The cycle begins again at higher debt levels. The supercycle today is global. Debt to GDP ratios in advanced economies are unprecedented. Emerging markets are vulnerable to capital flight. Private sector leverage is high. Real estate, sovereign bonds, and corporate debt form a delicate lattice. Any disruption can propagate rapidly. The lessons of history are clear. Debt fuels growth, but it also seeds instability. Leverage amplifies returns and losses. Systems appear resilient until they are not. Access and control often reside with institutions, not individuals. Understanding the debt supercycle is about seeing the invisible. It is about reading the patterns beneath headlines. It is about recognizing incentives. It is about anticipating stress points in a world that depends on continuous borrowing. Debt is not evil. It is necessary. But unchecked, it becomes a force that shapes empires, markets, and lives, whether we realize it or not. Welcome to Cash and Chronicles, where money, power, and history collide.